This evening we will begin with an inaugural session and then later proceed to a panel discussion. So it is now my pleasure to extend a very warm welcome to our esteemed guests to begin our inaugural session. I invite them now to please join me on the dais. Shri Rajiv Kumar Agarwal, full-time member, SEBI. Shri Naresh Tejwani, President, AMNI. Shri Siddharth Shah, Chairman, BSE Brokers Forum. Shri Ambarish Datta, MD and CEO, BSE Institute Limited. Shri Anil Bhandari, Chairman, ICAI WIRC. Shri Pankaj Jain. Shri Rishikesh Gagan Vyas, Chairman, ICSI WIRC. And our gracious host this evening, Shri Ashish Kumar Chauhan, MD and CEO, BSE Limited. A welcoming round of applause for our guests, ladies and gentlemen. Thank you. At the BSE, we like to start on an auspicious note, invoking hope and gratitude. So I request our esteemed guests to kindly proceed to light the auspicious lamp. Ladies and gentlemen, the purpose of today's seminar on taxation is to update the broking fraternity and investors on the recent developments and interpretations on taxability under business income for long-term or short-term with regard to listed equity, which is subjected to STT. The panel members will discuss the tax incidence of security transactions on different classes of investors such as FIIs, MFs, corporate and individual investors. Further, the panel members will discuss possible changes in regulations to minimize tax litigations and optimize revenue to the government. But first, let us start with the inaugural session. To commence the evening's proceedings, I invite Shri Ashish Kumar Chauhan, MD and CEO of the BSC Limited, to present his welcome address. Ladies and gentlemen, Shri Ashish Kumar Chauhan.
Shri Rajiv Agarwal, Mr. Tejwani, Mr. Siddharth Shah, Mr. Pankaj Jain, friends, ladies and gentlemen, it's a pleasure and honor to be in front of you. Basically, this idea came with our advisor, Mr. Jindal, who suggested we need to sort of also start working on details of the tax proposals, because usually we work on the broad activities on how the taxation should be applied. Especially, I have a strong view on the STT, and many of our members have strong views on STT, but there are issues relating to the investors, there are issues relating to brokers, and there are issues relating to exchanges. And we thought this will be an appropriate forum before the budget, where we gather the experts, take their views, create a paper, and then send to the minister for their consideration. So whatever the outcome of this event will be presented into a paper, prepared into a paper and sent to the Minister of Finance, and hopefully they will consider some of our perspective. And we have some of the most eminent personalities on the dais, and now in the tactical session we will have Mr. Rakesh Mohan, Commissioner of Income Tax, CCIT1, Mr. Ketan Dalal, Mr. Ramdev Agarwal, Mr. B.M. Jindal, Mr. Kanu Doshi, and Mr. Ashwin Parak. You will not see all of them in one room ever, except in BSc. So thank you very much all of you for coming, and really appreciate all the students who have come, who want to learn something interesting, and all the practitioners who have come today. So really appreciate all of you coming today. Thank you.
Thank you, sir. It is now my privilege to invite our chief guest, Shri Rajiv Kumar Agarwal, whole-time member SEBI, to deliver his keynote address. Shri Rajiv Kumar Agarwal.
Mr. Ashish Chauhan and other dignitaries on the dais, my senior colleagues, Mr. Jindal, Mr. Rakesh Mohan, and other esteemed guests, ladies and gentlemen. It's a matter of immense pleasure to interact with an audience as enlightened as this. Today the seminar has been kept on the tax issues, which is of course very close to my heart, because I belong to that fraternity. I thank BSc and Mr. Jindal particularly to invite me on this occasion and give an opportunity to express my views. Friends, we are passing through very interesting times. We are at a stage of the economy where we are launching ourselves to be part of a developed world. Timelines cannot be given. It may be 5 years, 10 years, or 15 years, I can't say, but that is a certainty. the present Indian society is very aspirational. Our youth is very aspirational. We want to grow at a rate more than 9%. We want an infrastructure which is as good as in any other part of the world. We want to have an access to an educational system which is best in the world. We want to have access to a health system which is best in the world. Therefore, our investment needs are very heavy. I think there is no reason why we should not aspire to achieve. We are a country, we are an economy which is well diversified, which is blessed with so many resources. For example, we have got a booming service sector. We have got one of the largest pool of the manpower. We have got the largest pool of the skilled manpower also. We have got a favorable demography which provides us continuous supply of labor as well as demand. We have very developed markets in all the commodities and other services. We have got a very sufficiently developed financial system which has got a good network of banks, exchanges, developmental institutions, insurance companies to provide intermediation between the savers and the users. We have got a very large crop of entrepreneurs in the country. We have got very high rate of savings as big as 30% of the GDP, which is next to China only. Still, we have got certain problems like very poor infrastructure, high inflation, which is of course coming down, and perennial problem of current account deficit. That problem is also getting resolved to a very large extent because of the falling oil prices. But friends, the poor infrastructure is a real handicap at the moment. But at the same time, I feel that this is an opportunity also, which will provide tremendous investment opportunities. But as I mentioned earlier, if we really want to fulfill our aspirations, we will require a huge pool of investment. That will be possible when we are able to raise our savings rate. Number two, we are able to mobilize larger and larger chunk of our savings to the financial markets or to the productive process. And number three, we are able to invite foreign investment. That will be possible only when we have very good network of financial intermediation and have very attractive products. If we really want to increase the efficiency of intermediation between the savers and the users of money, then the size of our capital markets has to increase maybe manifold. Because it is normally believed that the the capital markets provide for much more efficient allocation of capital. Therefore, more and more money has to be channelized through the capital markets, where risk capital is available. and the market enforces discipline on the users of the money. This growth of the capital market in future will depend upon 2-3 factors. Number one, the investors get attracted to the markets because of the higher returns, because of the safer returns, and because of the transparency. And also because the cost of transaction is lower and there is ease of entry in the markets. This will also require a very good network of the distributors of various products and a very good network of the intermediaries. This will be possible when we have very competitive markets, so that the services are provided to the investors in the most cost-efficient manner. That will also encourage the foreign investment in the country, because the foreign investors are also very cost-sensitive. If they feel that there is a difficulty in entry in the market, if the cost of transactions is higher, then they immediately have another options. Then the consequence is that our markets get exported. What I am trying to drive at is that the cost of operation, the cost of transaction in the market is very crucial. We have to remain competitive globally, and at the same time in the domestic market also, vis-a-vis other products available in the market which is out of the capital market, we should provide cheaper services. Only then the money will flow to the capital market. The taxation is one of the important constituent of the cost of the transaction. That is why this seminar is very important. The discussion on the tax issues are very crucial, particularly in the coming times when we want to improve the competitiveness of our market and stop the export of our markets to the other jurisdictions like Singapore or Dubai, etc. So friends, various tax issues are bothering the market. We have also received feedback from the various associations of the stakeholders, and I may mention that all these issues we have forwarded to the government for necessary action. Of course, the industry also has to directly pursue with the ministry and the government. But I would only like to highlight the importance of these tax issues, because this will improve the efficiency of our markets. So friends, I am sure that today's discussions will be very fruitful, and it will sensitize not only the stakeholders but also the government about the importance of these issues. And then if SEBI can do anything in this matter in taking up the issues to the government, we will be always forthcoming for that. We have already forwarded all the issues which we have got so far. If any other issue arises in future, we will take the necessary action in this regard. Thank you very much. I wish all success to the seminar, and thank you very much.
Thank you, sir. A round of applause for Shri Rajiv Agarwal. To commemorate this occasion, I would now like to invite Shri Ashish Kumar Chauhan, MD and CEO BSE, to present mementos to our wonderful guests. Shri Rajiv Kumar Agarwal, whole-time member, SEBI. Shri Naresh Tejwani, President, ANMI. Shri Siddharth Shah, Chairman, BSE Brokers Forum. Shri Ambarish Datta, MD and CEO, BSE Institute Limited. Shri Pankaj Jain, Central Council Member, ICAI. Shri Rishikesh Gagan Vyas, Chairman, ICSI WIRC. Thank you. With that, ladies and gentlemen, we are ready to now commence with the panel discussion on taxation and how it affects the stockbroking industry. Thank you to our esteemed guests for initiating the inaugural session. It has indeed been a pleasure to have you all with us. Thank you. A round of applause, please, for our esteemed guests. It is now my privilege to call upon our respected moderator and panelists to join me on the dais. They are all experts on the subject of taxation, and we're very grateful to have them with us today. First, Shri Ashwin Parekh, Managing Partner, APAS, and former Senior Partner, Ernst & Young, who will be the moderator of tonight's panel. Now for our panelists, Shri Ketan Dalal, Regional Managing Partner, PwC India. Shri Siddharth Shah, Chairman, BSE Brokers Forum. Shri Rakesh Mohan, Commissioner of Income Tax 1, Mumbai. Shri B.M. Jindal, Advisor, Tax and Legal at BSE and former Chief Commissioner of Income Tax. And Shri Kanu Doshi, Dean, Wellington Institute of Management. In preparation for the question and answer round that will follow the panel discussion, query slips will be provided to all audience members. Should you have a question, please write it down on the slip and include which panelist it is directed to. Our esteemed moderator will then shortlist the most relevant questions from all the slips collected. Now, as we begin our formal exploration into taxation issues affecting the stockbroking industry, I would like to invite Shri Ketan Dalal, Regional Managing Partner, PwC India, to give his presentation on the subject. Ladies and gentlemen, Shri Ketan Dalal.
Thank you. And first of all, Mr. Rajiv Agarwal, Chief Guest, Ashish Chavan, CEO of the BSE, Kanubai, Mr. Jindal, Mr. Rakesh Mohan, Mr. Siddharth Shah, Ashwin. One sec, technology always overcomes me, so while my colleague does that, it's a great pleasure to be here. Whenever one sees a presentation on the screen, one gets worried that this will go on and on, but I promise you it won't. Because I think the idea is to just set a context for the panel discussion to follow. And what I've got is basically 12 to 15 slides to just highlight some of the issues. And before preparing for this presentation, I had a conversation with a couple of interfaces within the BSE, including Mr. Jindal. And I thought, let me put together the issues that are relevant to the stockbroking industry. But in doing so, I've taken two perspectives. One is obviously the clients of the stockbrokers, which is the investing community, which would include an FII, etc. as well. and one is the stockbrokers themselves. And there are so many issues that one can't deal with all of them. But what I've done is to highlight those issues which I think are more relevant. And at the tea break, we were discussing. We are already on the 5th of February. The budget is there on the 28th. We're just over 3 weeks from the budget, and many representations have been made. Some will still be made, but I suspect that those which have already been made are the ones which will probably be considered, because now it possibly may be too late, but one can still try. So I think we'll also put some futuristic perspective. Mr. Agarwal, you mentioned that we are at a very interesting stage of the economy. So I thought I'd make 3 broad preliminary comments to contextualize the presentation. The one is that one of the problems that we are facing, and I must say the government in the last 9 months has done a lot, and while tax is a very, very difficult subject, some changes have been made in the last few years as well. But I think one of the big issues, my first point is that there is a very serious need to align laws to reflect the current reality. And REITs, for example, is a classic example, and I know how much work SEBI is putting into it to make REITs actually see the light of day, because my initial reaction when REIT came was, no, this should be okay, but when I went deeper and saw the fine print, I realized that there are lots of gaps. So that alignment is a problem. The second is the uncertainty of tax law is the heart of the problem. People say, I don't mind. I have clients, international clients say, instead of 10, I don't mind paying 15. But tell me it is 15. And tell me it is 15 on 100 as opposed to 15 on some uncertain number which turns out to be 500. The third point, which is an extension of the second point, is I am very firmly of the view that the problem of Indian tax law is not the law. There are problems in the law, but it is actually not the law. It is the administration of the law on the ground. This is the heart of the problem. You can go on and of course this is not a technical session in that sense, but if I give you one example, you would have been seeing Shell and Vodafone and transfer pricing and all that. The law on that looks exactly like the European law, the OECD law. On the ground, what happens is completely different. So with these 3 preliminary observations, let me, without further ado, launch into the presentation. Now, where's the down button? Dignesh, this one? Yeah, okay. Yeah, so this is just the broad contents. I already took you through this. Really nothing much in this slide, but just one point. If you see, the definition of securities and all is very broad, and again, this is not a sort of over, and I am aware that there are some students here, but I have to bear in mind the context of this seminar. This is just to set the context, and really, if you see from an income tax standpoint, and Ashish Chauhan mentioned about the STT, so I won't go deep into that, but that's not the purpose. But if you see the point stating income tax, I just want you to focus on the fact that in the context of shares, and we primarily talk of shares, and a lot of things can apply to debentures, etc. There are 2 sets of income that we are talking about. One is the recurring income, which is primarily dividend in the context of shares, or interest if it is, say, debentures. And then second is what I call exit income. So when you sell, and there of course one of the big problems is it business income or capital gains, and that's a big issue worrying both the stockbroking community as well as their clients, and we'll talk about that a little bit. So if you just look at the big picture, you step back and look at the big picture, it's what is there on the screen in front of you. You could either have business income or you could have capital gain, and within business income you could have what I call normal income and what I call speculation income. And there is a significance of that because there are certain issues on set-off of speculation losses, etc. Against normal business income, and therefore it becomes important to classify an income as one or the other. And in capital gain, of course, as you're aware, you have long-term and short-term. There are various other ways you can slice it: gains versus loss, resident versus non-resident income, and so on and so forth. But very broadly, the big picture is what you see on the screen. Let's deal with something which is occupying, and I know that this is occupying the attention of the Bombay Stock Exchange, and Mr. Jindal pointed out to me that a lot of work has gone into it, and which is the controversy of business income and capital gain. I'm glad to see Deena being here. We've discussed it quite extensively. The issue is the following, that if something is capital gain, the taxability is lower than if it is business income. And if that characterization is, let us say, a loss, and then the further controversy of speculation versus non-speculation, and Dina, when you made some significant efforts to bring in an amendment which has partly worked, but partly needs some tweaking, and I'll refer to that, then the characterization becomes extremely important because the implications of that characterization are different. So without going into too much technical detail, if I were to give you the broad message, you know, there are several judicial precedents. In everything in tax, there are very many judicial precedents, and sometimes I feel that many of these cases and controversies do no more than keep people like me in business. I'd rather prefer to do something constructive, but if the litigation is there, we will deal with it. And the judicial precedents broadly have laid down several principles, and then in 2007 a circular of the CBDT came up which laid down a lot of parameters to say, is it business income or is it capital gain? And you see most of them on the screen. That in the books of accounts, for example, is it treated as a stock in trade or capital expense? The second bullet, I'll park for a minute, and I have a lot to see on the second bullet. Just park it. Volume and frequency of transaction, ratio of purchase rate, holding period, treatments in books of accounts, and so on and so forth. And I think they are all sensible tests. The problem is they are obviously all subjective tests, and it's fine to have subjective tests provided the subjectivity judgment is exercised sensibly. The problem is sometimes it is, very often it is not. But I do want to make one point on the second bullet. And this is a classic example, absolutely classic example of something which is completely out of tune with reality. And that is the intention of the investor at the time of purchase, profit or dividend, pray, in the last 20 years, who on earth, and you will always have an XYZ dividend yield fund and something or the other, and there will be the stray cases. Who on earth normally, in 98% cases, invest in shares for the purpose of dividend? Absurd. Now, if I am not investing in shares for the purpose of making profit, then pray, why am I investing at all? Now, if you use that as a criteria to say that if you invest for profit, your business, and if you invest for dividend, your capital gain, you killed the matter before it begins. The absurdity of this is the classic, and I would urge Mr. Agarwal to make this point to the CBDT. The absurdity of this is in an era which has gone 10 years ago, 15 years ago, maybe even 20 years ago. But still it came in 2007. Nobody invests in shares for the purpose of dividend. The fact that I am investing for profit doesn't mean it is business. If I am doing 50 trades in a day, I can understand. If I am a day trader, I can understand. If I do 2 investments in a year, or 5 investments in a year, or 7 investments in a year, that's all, for example, and this is just an example. It is highly unlikely that I am a trader if I am making, let's say, 1 trade in 27 days, for example. But this is there. Now, this is the kind of thing which is leading to the controversy. Now, I don't want to take you into a whole host of case laws, but you know, there's a Mumbai tribunal decision in Platinum Asset Management, etc., which says, after considering all this, that even for an FII, it is capital gain. Now, one might take a stand that an FII would normally be trading, but still they have held it to be capital gain, and in fact, the legislature has amended the law, the government has amended the law to actually expressly clarify it for the purpose of FII. But that clarification is not there for the purpose of a normal investor. For that matter, it's not there even for private equity. You know, in fact, surprisingly, in a what I would call positively aggressive decision, there is also a tribunal decision to say that for an FII, even in derivatives, it is capital gains. Now, that may have gone a little far, but it's there. But for a normal investor, the aam janta, so to speak, and people like you and me, there is no such clarity. What is the result on the ground? Endless chaos. So, the subjective tests are actually not bad tests. They are quite sensible except for the second bullet. But the implementation on the ground is a problem, and therefore what is the thought? Jindal was mentioning that there could be something to tell the government, look, can you make it into something like a time-based test, that if it is 3 months, then it is business, if it is more than that, it's capital gain. Now, I don't want to go into whether that is good or bad, but that is one possible view. And while doing so, one has to realize that if you do it for a normal investor, what does it do to an FII and so on and so forth. So I don't want to get into that. But either there has to be some objective test, or to two things have to happen. The second bullet has to go, and there must be some further examples given to say that this is the way it will be interpreted. While the subjectivity will not disappear, the subjectivity will become lesser. So let's move on. Let's talk of recurring income. The recurring income dividend, of course, is no longer taxable in the hands of the investor. But I just want to pause for a minute, and because it has got some relevance to deductibility, I am very clear in my mind that dividend is being taxed. The tax is being paid by the company, and if the shareholder is the owner of his proportionate share in the company, is effectively commercially bearing that tax. But it does not seem like he's paying the tax because they keep on saying, "हमको तो tax free मिला, तुमको tax free नहीं मिला, company ने 20% भर दिया, पर तुमको पता नहीं मिला." So it is not really tax free, although technically, theoretically, it looks tax free. Okay, and as I said, there is an implication because income expenses cannot be deducted against quote unquote tax free income, which technically this is deemed to be. Okay, and the second is, as I said, even that interest or dividend, if at all it were to be taxable, it won't be in most cases, at least technically, then it would be held as business income, otherwise income from other sources. And again, this is more relevant to the interest part than the dividend part, and therefore more relevant to the debenture part rather than the share part. Let's come to the exit income. As I said, if it is business held as stock in trade or business assets or its trading portfolio, then it is business income, and we saw in the previous slide the challenges of categorizing that in the first place. But assuming that the tax department agrees that it is held as investment, then of course the exit income will be taxable as capital gain, either short term or long term. If held for trading purposes, as I said, it will be taxable as profits and gains of business, and I will just come to some of the challenges on that in a slide or two. I mentioned about FII, which is by the way now called FPI, Foreign Portfolio Investors, and the securities held by FPI are now considered as capital asset, and therefore the controversy of whether it was capital gain or business income has gone away so far as they are concerned. I just want to step back and maybe jump the gun a little bit. There's something coming in the next slide. So far as business income versus capital gain on a cross-border basis is concerned, like an FII, there is this concept which you must have heard called permanent establishment. So suppose you have a presence on the ground, is it a PE or not, etc. And the implication of a PE is only if it is business income in the first place. The concept of PE has no relevance, PE as in not private equity, but PE as in permanent establishment. The concept of permanent establishment has no relevance if it is capital gain, and that is what they have clarified. I think this was the whole idea was to incentivize fund managers to be located in India. Before I move on to the next slide, there are only 4 or 5 now slides. Just the punchline at the bottom. It's actually not linked to the remaining part. MAT. You know, there has been some notice issued by the tax department on MAT on FIIs. And I think it was completely unwarranted, and I think to be fair to the tax officers, they are actually also saying that we also don't think it is leviable, but the audit department of the government is taking the objections of what do you expect us to do. So you can't really blame them. And I think it is very important for the CBDT to clarify this, because I think everybody knows that MAT was never intended to apply to an FII kind of situation. It first applies where you have an Indian balance sheet, so to speak. But it's there, and one is hoping that the budget will clarify. You know, and one can always see some words and say, but इसमें तो ऐसा भी interpret कर सकता है, etc. And I always say that words are an imperfect expression of human thought. And that thought, the thoughts are not, you know, they are not clearly articulated, then one has to read it commonsensically, because there is a substitute for everything in the world, but there is no substitute for common sense. So unfortunately, this controversy needlessly has arisen at a point of time when we are at the cusp of far bigger things, far better things, far more important things, and when we should be devoting our time and energies to something sensible as opposed to some absurd thing like this. But anyway, it's there, and again I would urge SEBI to look at that, because I think everybody knows this was never intended. But once this controversy has arisen, it has a life of its own. You will soon see those 50 notices getting converted into 50 demands, and before you know, the market will collapse by 2,000 points for the wrong reasons and not for the right reasons. Non-residents capital gains tax, the indirect tax transfer, the Vodafone controversy, etc. Again, this can have relevance from a stock exchange, wherein, let's say, an open offer is made for a company outside India, etc. It's pretty technical, so I'm not going into it. Again, from a day-to-day perspective, this has limited relevance. The only point I want to make is that they've amended the law, which is fine. I just wish that they had not done it retrospectively, so let's see what happens in the budget. From the perspective of non-residents, whether private equity, whether FIIs, and obviously dealing through the stock exchange or otherwise, there are exemptions, and this may be relevant to an investor who has a short-term capital gain, who would otherwise be paying tax, but if he invests through Mauritius, Cyprus or Singapore, he would not be liable to tax in India because of a treaty exemption. And I just want to make one point here, and again, SEBI and Bombay Stock Exchange should consider. Take the case of Mauritius here. Everybody knows that the Mauritius company in between normally does not have substance. That's the reality of life. It does not have substance. I mean, I've been to Mauritius 4-5 times at the time that they started, and they're all in Port Louis, etc. And they are relatively share companies. Again, there are two types in that. One is a pooling vehicle in Mauritius, such as a fund, and second is a pass-through. Neither of them has a substance, except the pooling vehicle in that sense has greater credibility, because at least there is a reason to be located somewhere, and if that somewhere is Mauritius, so be it, because it has a benefit. The point I want to make is this, for the benefit of the representation that need to be made, because it impacts the stock exchange. The Mauritius exemption was based on getting a tax residency certificate. One might say it is tax avoidance, but at that time India needed money. Today, you can't go on having double speak. You can say, I believe that this blessed tax avoidance, if I were to call it that, should be done away with, and in phases we will remove it. That's one way to look at it. And then whatever happens to the market happens to the market. The other is to say, is there and we will live with it. And even when general anti-avoidance rules comes, one will have to specifically address the issue of Mauritius rather than hoping that it dies away somewhere or goes under the carpet, because it won't. The reality of life is it won't. It will surface. The problem is that today this is another issue of uncertainty. Is there or not there? So it's like saying there is an exemption but there is no exemption. So nobody knows what's happening. But in technical position is that there is an exemption. So again, I won't go into technical details of some of this. Very quickly, last 2-3 slides, as I said, income characterization, there are under the portfolio. Now this is under the portfolio management scheme. So even when you call portfolio management, it sounds like trading. So my portfolio manager is DSP Merrill Lynch, for example. But I hardly do 15, 17, 18 trades in a whole year. So in my mind, that is not a trade at all. It's investments. But sometimes tax officers pick the word portfolio management and say, oh, this is portfolio management, so it's trading. It's not really. So there are decisions, majority of them are in favor. I've put some of them down. And similarly, there are decisions to say that against the portfolio management fee should be deducted. So if you have got capital gains, the portfolio management fee should be deducted. Now one can go on arguing on wordings, but if you see the logic of it, I'm paying the fees because I want to make a profit, and I've made a profit, then you give me the deduction. It's as simple as that. So I think the alignment of the commercial reality with what is happening on the ground needs to be done. Coming to the brokers themselves, and many of these will apply to their clients also, and some of it we've discussed already. So I think the issue is that this is on the speculation part. The distinction of speculation versus non-speculation is delivery versus non-delivery. So if you're on the left-hand side, you have the shares and commodities basket, the right-hand side is the derivatives basket, which would necessarily be non-delivery based if you sell the futures or options. So the non-delivery is considered to be speculative, and the delivery based, the cross means it is not speculative. And in the deemed speculative, if you see the second box below, deemed speculative, there's a question mark, and Dinaben, that is the controversy I'm talking about, and I'll come to it in the next slide. Sorry, I forgot to mention, if it is a speculative, the relevance is this. If it's a speculation loss, then under the provisions of section 73, you can't set off the loss against the income, and therefore logically, if you have a case to say it is not speculation, you would prefer it that way, because then you can set off. That is the implication of what I'm saying. Okay. So, for some strange reason, there was a provision in law that where any part of the business of a company Okay, it's just for a company. Is XYZ dealing with shares, then the company shall be deemed to be carrying on a speculation business, even though it is actually not so. So, I don't know what is the logic, but perhaps the feeling was that companies, even though they may be small companies, somewhere in some mind of the government must have that the company doing that business, let's discourage it by calling it speculation. That may have been. But now they have put a word other than a company, the principal business of which is the business of trading in shares. Now, as I said, Dina Bennett made a lot of effort to get this amendment done. So it's like saying if the principal business is that, then you exclude it, but if it is, so to speak, non-principal, then you consider it as speculative. Now the word principal has created a controversy. So let's say the case of a stockbroking company. The stockbroking company's principal business is broking. So now that loss will again be considered to be this. So again this word principal business has created a controversy, and that I'm sure some representations have been made on that. A few quick points, for the brokers. Do you get a deduction on loss of error trades? Do you get a deduction on bad debts? Now, so far as error trades are concerned, there are decisions to say yes, you must, and I think that's logical, because if you make an error, that's an incidental part of your business. Just as you make a loss in business, it's an incidental part, so you should get it, because sometimes you make a profit also by error, right? And you tax it. Okay? You just hold on to some products and suddenly it goes up. So it's not an error as in a mistake, but it's an error as in luck, and you're taxing it. So I don't see any problem with this. The bad debts on non-payment by clients is a technical issue. That bad debts is allowed when you have taken it as income, but the income is only the broking. So the debt from the client has never gone as part of the income. But there are provisions in law to say that an embezzlement loss, for example, is allowed on commercial rational basis, and therefore this should also be allowed. So there is a controversy. Some say it's allowed, some cases say it's allowable, some it's not allowable. This is another area where the government should clarify. The last bullet is important. This is the interest. There are interest and other expenses, but let me take interest. Let's say you take a loan to invest in shares. You are not today getting a deduction because of a provision in section 14A, which says that interest or expenses on exempt income is not allowed, and I made a mention that dividend is technically exempt income, although in commercial terms it is not exempt. So you are not getting a deduction of that, and we have already made a representation from various bodies, including one where I am the chairman of the direct tax committee, to say it is actually taxable. But I am not physically paying that tax, the company is paying on my behalf, so you should give it as a deduction. I don't know whether these representations have been made by BSE. So that brings me to my last slide. Some few key takeaways from the presentation that I made in the last 20 minutes. Clearly, one is the need for more certainty on characterization of income, which there are various, but business income versus capital gain, and indeed within business income speculation versus non-speculation. I also mentioned about the need for clarity on deductibility of portfolio management fees. The third one, which is subsumed as such in the first one, is that the deemed speculation should not apply to stockbrokers. And in fact, there should be clarity on what they even mean by principal place of business. And there are other matters like MAT should not apply to FPIs, etc. So with that, let me close here. Thank you very much, and I hope you found it useful. Thank you.
Thank you, sir. It is my pleasure now to call upon Shri Ashwin Parekh, Managing Partner, APAS, and former Senior Partner, Ernst & Young, to moderate a panel discussion on the subject of taxation with regard to stockbroking and related matters. Over to Shri Ashwin Parekh.
So I suppose we've started the seminar quite well with an excellent inaugural session. It set out the perspective, and thereafter Mr. Ketan Dalal has really provided a very wide-ranging perspective on various aspects which can come up for panel discussion. I'll just make two observations. We have an extremely learned panel over here, and I suppose, we should give more time to the panel members. One observation, of course, is just to structure out the seminar from now on. We've got about an hour and a half, and we've got two things now to achieve, three things actually. First is we've got a panel, contribution, so each panel member will really put out their perspective on various aspects, which were covered, and in additional aspects as well. Thereafter, so I'll request each panel member to take about 5 to 7 minutes just to do that. The next half an hour perhaps we will devote in discussing with the panel members themselves. There can be an inter-se discussion with the panel members. So if there is anything, any new dimension that the panel members want to add to any matter that was discussed by Mr. Dalal, then it could be taken up by Ketan, then it could be taken up. And then we have participants who have various questions, and they'll put out their questions, and if we have already covered them earlier, then I'll just read out the question and I'll say if it's been covered. Otherwise, we'll take the whole thing up. So that's the structure of the panel discussion now. Just to give it a perspective and make the most out of the seminar. I'll just give one background note and then I'll immediately move on to the first panel member. Mr. Shah will then talk about it. The observation is a very simple one. And I mean, if I just take from the inaugural session and what Mr. Agarwal said, and then from what Ketan was trying to point out, 2 or 3 perspectives. One is, we have to recognize that if domestic savings have to grow, and if the domestic savings have to be channelized in capital markets, in securities, then in that case, the complexities which arise in the taxation arising out of security investments must also be addressed as more critical or more important. I mean, over my last several years of practice, I've realized that an investor gradually migrates from one level of complexity, in investments to the next. He'll start off with perhaps deposits, bank deposits, which are the least, difficult to interpret or understand. From there on, he migrates perhaps to capital markets, he invests in funds or in securities, and then he migrates to insurance and pension at a certain age. The trouble with the second layer is that the second part expects the investor to know so much about taxation, expects him to really understand, otherwise the gains that he may make out of his investments may not really come to him, and that's the perspective with which Ketan provided a very good understanding of what are those complexities basically. Second observation is last roadshows, FII roadshows. In last 8 years, I would have met about 30 to 30% of, that is in terms of their investments, people who made investments in India. And only one thing they say compared to many countries in which they invest, Indian taxation is the most difficult to understand. Law is very simple, as Ketan said, but interpretation can be manifold, and that's where the complexities lie. With that, Mr. Shah, you can just provide your perspective on the subject basically.
Good evening, friends. Sir, you mentioned about migrating, how investor comes to the capital market. It starts with the investment in, first it's just FD and then comes to the market. There are a number of instances which I can point out where the existing investor, retail investor, is running away from the market. And they were here for almost a decade, and there were instances because of uncertainty of the taxation. When he trades, he doesn't know how he is going to be taxed down the line. Ketan has very well explained to us. So, and apart from that, the discrimination, discretion which is given to the assessing officer to decide on whether it's a long-term, short-term, or the business income. That is something wherein investor says, I don't want to invest, I better invest in something else. Apart from that, the information called for during his assessment, specifically what we call AIR, wherein even he does an investment of even a 2 lakh of rupees in the capital market, is picked up for scrutiny, and whole sort of information is asked for. Number of transactions he has to go and explain. And what we understand, when we go to income tax officer and explain to him that, okay, this is a transaction done, he only verifies the bill issued by the broker. No more value addition he is doing and says, okay, now it's clear. But he has to go through the entire harassment and the process he has to go through. So these are the few instances by which existing investor who were with us, they said that I will not like to invest in the capital market. So the second part is about dividend, as he explained that though in commercial term dividend is not tax-free, but assuming it's a tax-free in the hands of investor, subsequently on assessment that 0.5%, I may not be exactly knowing the section because I'm not conversant with those sections, but 0.5% of the dividend is of the assets, investment assets, which will probably would have given dividend. So sometimes there are instances that dividend is 5 lakh and disallowance is 10 lakhs because whole entire assets doesn't pay dividend. So this is the second point which is also bothering. And now this stage has come. What I feel is that entire transaction is digitalized. Stock exchange has all the data. So why this, again coming to the first point of deciding on whether it's a business income or it's a long-term capital gain or a short-term capital gain. Because when I invest with some target. So that target is maybe achieved in the same day, 10%. So I sell it off. But in this slide, he's explained, it's a speculation trade, it's intraday trade. But intraday trade happened because I wanted to invest for a long term. But I got my target, I sold it off in the market. So that's to be treated as an investment activity. One suggestion, which I just want to throw open on the floor for discussion, saying that there is a short term and there is a long term. Why can't we have something called a short term, a medium term, and a long term? A short term, wherein we are saying it's say for example, less than 1 month. Medium term is say 1 month to 12 months. And long term is obviously about 12 months. What I'm trying to do is that investment in a cash market, where the intention is to remain invested. But because either my target on positive side or on negative side, it has reached and I have to square off the transaction. So treat these as investment only. Don't treat this as either speculation or comprehensive business income. Different tax slab can always be applied. Let's say 10%, 20%, 30% kind of a thing. That's again a matter of little discussion. But we are saying at least for the transactions, because it is digitalized, very easy to understand. And last one point which I wanted to make is about the audit, provision for audit. Because audit is, when it's based on your turnover. And in capital market, turnover is manifold. Okay. So 1 crore of this is too less. And if at all there is section 44AD, if I don't know this correct. So if it's less than 1 crore, but then 8% profit resumptive tax you have to pay. In our market, 8% on a turnover is never the case, kind of a thing. So these are the few couple of points. And what I want to highlight is if streamlined, I think retail participation definitely will come back. And the backbone of the capital market is retail investors. So that's what I propose.
I think these are two interesting, very interesting, in addition to some of the difficulties that you pointed out. The whole definition of period or term, whether a medium term could be considered for the purpose of taxation. And the second important part, that you talked about was the threshold for audit, basically. That's something that is a good takeaway. Just to make the most of the seminar, friends, what I thought we could do is, I'll request all the panel members to put out their views once again on the site. I mean, Mr. Jindal will create some environment where you can put out those. If you have to go by what Mr. Chavan said earlier, if there is going to be a paper from this forum, which has to go to the government and which has to go to the Ministry of Finance, then I suppose the panel members can really start the contribution. Ketan's material is the base point. We take that as well, and then you can add on, each member can then add on some of the points. Because otherwise seminars end up in discussions, we interpret and we try and attempt looking at our own problems. Solutions have to be heard by the ministry or by the government. And unless you give the government an opportunity of saying what exactly should be there, it doesn't work basically. So that's the observation that I would like to make with you. May I now turn to Mr. Rakesh Mohan and request him to another please. 5 to 7 minutes, sir.
Ladies and gentlemen, eminent personalities sitting on the dais and friends. 5 to 7 minutes is too short a time for any communication of my thoughts on the subject. I would like to talk at 3 different planes. First would be a small response to what other speakers have said. The second part will be some of my thoughts where perhaps we should have deliberated. I would like to put across. And in the end, some warning signals to the share brokers sitting here. As I am looking at the income tax department taking a stand and going ahead, some of the critical issues where we are likely to face problems with the department, which will be very interesting. Coming to the issues that have been raised already, the short-term capital gain, long-term capital gain and business. If the motive to begin with is to earn profits, where's the difficulty? It's business profit. Why bother about whether it is short-term capital gain, long-term capital gain or business? With due respect to your thoughts, if the motive really is business, because the entire issue of capital gain, short-term, long-term, business profit, the basis of decision making is the intention of the person. That is the starting point. If you can establish the intention, none of the other criteria is really required to be satisfied. So perhaps if you go into that issue, it becomes a non-issue. Going ahead, my practical experience says that most of the difficulties are coming up because we are not able to establish our intention. Our documentation is weak, and there, don't mind, but it is the CA community who is to be blamed. They are not guiding the investor, the share broker of how to maintain the documents to establish the intention. In corporate entities, we have a clear-cut division. Stock and trade, investment. Why not for others? Once that division is there, things will be far easier than what we have today. That's just a small thought from me. MAT provision, applicability of MAT provision. See, the definition of company, it is applicable to a company. And Section 2 in the Companies Act defines what is a company. It includes a foreign company. I don't see any doubt on that front. That MAT will always be applicable to foreign companies, irrespective of whether exempt income exists or whatever. In this slide, there is the issue of TDS. I think you did not elaborate upon it. But then be cautious. Mumbai ITAT recently has come up with an order saying that forget double taxation agreements. TDS has to be deducted because whether an income is taxable or not is the prerogative of the assessing officer. Unless the assessing officer decides, yes, this income is not taxable, you have got to deduct TDS. This is one major issue where a reference must go to the government to take some step. Otherwise, every payment that is made to the fund will be subjected to TDS. I hope I am making that point clear. Next issue was the issue of Section 73 that was raised is continuing to pose problems. Because the amendment is only talking of trading in shares. I think we need to take some step over there. Deductibility of bad debts on non-payment of clients. I don't think there is any difficulty there. Because it is taken care of by Section 28. We don't have to go to bad debt sections. Section 28 itself says if there is a loss, there is a loss. It has to be taken care of. The portfolio management fees. I have some very simple thoughts on portfolio management fees. Are we, through the portfolio manager, investing or trading? If you say that through the portfolio manager we are doing a business activity, all expenses are naturally allowed. So offer that income as a business income, portfolio management fees gets allowed. But you are talking of capital gains, you want the benefit of capital gain. Capital gain is a deeming provision. The capital gain itself is deemed to be income, it's not an income, it is deemed to be income. Then whatever the legislature says whatever there is in the act, that alone can be allowed. I don't think portfolio managed fees will become ever allowable in the present scenario. Something radical will be required if you really want that to happen. The second part of our friend Mr. Ketan Dalal was the implementation side. A direct hit upon me, upon my establishment, that it is the implementation which is posing problem. Yes, I agree. I definitely agree implementation is a problem. But we need to understand what has happened to the department. We have been in the process of restructuring since 2000. We have had one restructuring in 2000. We have recently had another restructuring. As a result, we are developing, we are evolving into a top-heavy organization. And the ranks from down below have come up. If you look at the entire fraternity of the ITOs that we have today, the income tax officers making the assessment, they were maybe a year back at the clerical level just calculating the tax. Now they have been seated to do your assessment. Obviously they are not aware of the provisions of law. They are not in a position to take a decision. That's my personal view, don't quote me. Now if you want to wriggle out of it, there are possibilities. If you are getting trapped into some major issue, please resort to 144 section 144B. Get the matter referred to the additional CIT, ask him to give directions. That is a way of where some solution is possible. But I'm sure you'll have to bear with this situation, with this scenario, it's not going to change. Some benefit you can have through the additional CITs. It's a long going thing, nothing can be done, honestly nothing can be done, don't expect anything to change there. Coming to the second part that I thought of, some of the issues which I would have preferred to be taken up was the gap in the pass-through entities. Very critical from our point of view, from the point of view of stock market in India. The pass-through entities provision is just permissible only to the VCs and that to the category 1 VCs. I would suggest that a reference be made that this pass-through character be made open to other categories of investors also. See, the pass-through character is only available to VCs, not to other entities. That's a major issue which should have been taken here. I don't know why this issue is not coming up. This has not been referred even to board so far. I mean, maybe it requires an amendment in 1023, whatever. There was a second aspect which I had in mind. Apprehensions regarding the GAR provisions. In the new regime that we are going to have from April 15, the GAR provisions have the potential of breaking the structure that has been followed in the past 10-15 years or whatever. Now, if that structure is changed by the department for any group, for any mutual, any organization, then you are going to have trouble. There's a serious need to think on some changes in either the GAR provisions or kind of protection to the existing structure that was there, which is not changed so far, which was legal structure, which was accepted structure. Otherwise, there is going to be a problem. The moment we start implementing GAR, you are coming through the route of Mauritius. That's a tax planning. We are likely to break that. Once we break that, what will happen? Just think of that situation. Why the The US investors are routing their funds through Mauritius. Is this not only to save upon tax? Yes, there is no other purpose, and it is directly hit by GAR provisions. So assessment year 16-17, department is going to take up that issue. They are going to break up your structure. If nothing is done by so start thinking on requesting for some changes in the GAR. We have been concerned about fund managers and all. Why don't we request for safe harbor for fund managers? Very safe route which will benefit the foreign investors sitting abroad, appointing a manager, and get certainty about what tax liability is going to be there. So safe harbor rules extended to managers is going to be a very good proposition from the long run perspective. This change in the Act regarding 3 years criteria for long term in case of private limited companies. This is going to be adversely affecting the convertible preference shares. Because if you had planned for conversion in 2015-2016, the time period for 3 years will start getting counted only from the date on which the conversion takes place. The entire planning of the funds is going to go wrong. Some serious thought is required there. Again, we are perhaps also trying to look at the funds coming to India, the certainty level that we want to provide to foreign investors and all. And the issue of indirect transfer is really going to adversely affect the scenario. If the asset base can be established to be in India, there is no explanation within the Act of what is going to be substantial asset in India. In which case, a single share transaction abroad is going to have tax liability in India. We are not thinking on those lines, perhaps. We really need to go into those issues and think of the implications that we are likely to face in the times to come. Maybe some threshold can be requested. Then some thoughts that I have where department is watching and the share brokers in particular need to be cautious. If you permit me, the first and the foremost is the currency derivative. We are not paying commodity tax. We are not paying STT. What is the nature of this transaction? I mean, it's for our chief guest today to think it over. In the definition in 2H, currency is missing. Now, we in the department are seriously considering that a currency transaction will be a speculative profit in the absence of any insertion of currency in section 2H of your provisions. That is going to very adversely affect the share market community. A second caution is the third party RTGS being resorted to by the brokers. We are on the watch. A third is the frequent cancellations of F&O open positions despite assets being there. Frequent cancellation of F&O open positions despite backed by assets. Why? That issue is likely to come up very soon. And F&O notional loss, of course, will not be allowed, just keep in mind. And we are also noticing sub-brokerage being paid. A family, 6 members, sub-brokerage is going to all the 6 members of the family. Are they really working? Do you have terminals for them? I mean, these are the practical sides where Income Tax Department is going to take these issues in the times to come. So just a word of caution there. Thank you.
Mr. Anushman, thank you very much for some of the thoughts. In fact, what we will do is, I suppose in the inter-se discussion with the panel members, there will be members who would like to ask some questions to you, sir, and seek some clarification, seek some directional issues. I'll just quickly make an observation, and this is something which is coming out from your deliberation, your point only, sir. And that is somewhere along, and you can react to it later after the panel members have really come back, and this is my question to you. Are you getting a sense, in the tax laws and the way the taxation happens to various investments, that ideally savers should be actually encouraged to invest in long-term investments and medium-term investments? The taxation system somehow pushes him to invest in short-term investments. Duration is a larger issue than the quantum of savings that we have. The quality of savings, Mr. Agarwal talked about initially, 30% of GDP, but more important is also the tenure of savings, basically. Capital markets and investments around capital markets have a medium-term connotation. Banking is a very short-term kind of an investment proposition. Why is it that taxation becomes more and more complex for longer duration investments? Is something which I thought I will take your observation on, basically. I'll come to Mr. Jindal now, and sir, your time. Putting your thoughts across to us.
First, I'd like to deal with the deductibility of expenditure with reference to PMS. Portfolio management services similar to investment in the mutual fund. And in the industry of mutual fund, the deduction of 1.5% to 2%, whatever it is inbuilt. There is no separate disallowance, there is no separate deduction is required to be made. So it is not fair not to allow any expenditure in the case of PMS while computing capital gains, short-term capital gain or long-term capital gain. But as per the existing provisions of law, there is no provision under which the same can be allowed. Section 44, it can't be allowed under Section 44. There is a decision of Pune ITAT in the case of KRA holding in which the deduction has been allowed in respect of the expenditure. But then again the Bombay ITAT in the case of Homi Bhabha has categorically held that such expenditure cannot be allowed. I agree more with the decision of the Bombay High Court and it is Bombay ITAT, and it is likely to stand the test of appeal. So at present the position is that no deduction can be allowed in respect of expenditure PMS. Rather, you may face music if you claim some expenditure. The income tax officer may be inclined to treat your income as business income instead of income under capital gain and short-term capital gain. However, this is not a difficult situation. We can make a recommendation to the CBDT or Ministry of Finance that whatever reasonable amount is considered, maybe 1.5 or 2, can be allowed as deductible expenditure while computing the income from income under the head capital gains from portfolio management services. The other problem which bothers my head and which is really I consider a serious problem for the ordinary and small taxpayers. Some small investors come to me and ask me, sir, how many transactions we can do in a year? Or to what extent, or I say this is a difficult, I can't tell you how many transactions you can do. Then they say, you tell us the amount, whether 4 lakh, 5 lakh, 7 lakh, what was the amount? You see, after serving the department in 30 years, I am not able to guide him. I'll request the panel members to guide me if they can give some test guidelines. Whatever guidelines have been provided by the CBDT, with due respect, that is all vague, most subjective, nothing can be inferred out of that. The assessing officer has been given unfettered discretion, most arbitrary discretion. He is the master, he can do whatever he likes. I'll show you one or two samples what the board has laid down the guidelines. Bear with me for 1 minute. One of the condition in there are 2 circulars issued in this regard. One was issued in 2005. Those were in the nature of instructions or guidelines. Various tests were laid down. And then 2007 another circular was issued. It was based on the basis of various conflicting High Court decisions, Supreme Court decisions, and the decision of the Tribunal of Advanced Ruling. The condition 3rd is the test laid down, whether scale of activity is substantial. Substantial word has neither been defined under the Income Tax Act nor by the board. You can take interpretation the way you like. Why they can't fix a particular limit that substantial turnover or scale of activity will be more than 10 lakh, more than 15 lakh or like that. The other condition is time devoted to the activity and the extent to which it is the means of livelihood. Who will measure the time devoted by it? A retired man has nothing to do. He goes to the stockbroker, sits there from morning till evening and doing his business. Then he asks how many transactions I can do. I say I don't know. It is for the ITO. ITO can do whatever he likes. So why don't decide this time? Would you treat him as a business? It's a business. If he's sitting there from morning till evening and he's also deriving his livelihood also from that. The poor man gets some pension, some short-term gain and long-term. Then you say you can't do transaction. It should not be for the profit. It should be okay. I have invested for creation of wealth so that I should invest in sleep. I have to check. I have to do transactions to ensure that my wealth is not destroyed. If the company has failed, if the company has losses, I am bound to sell the shares. So the transactions, I can do so many transactions for protection of my wealth, for creation of my wealth. So this is all, whatever these guide tests which have been laid down are extremely subjective. It doesn't make any sense. We should go towards some more objective test. Why can't we say at least leave the people whose total turnover is less than 10 lakh? Nobody can do share business by having total turnover of less than 10 lakh. So why we are not keen to give some positive test to solve the problem of the ordinary and small taxpayers? The big and high net worth individuals, etc., can afford the services of the top tax experts, but the ordinary citizen, ordinary client of the share brokers who are medium class, they can't indulge in all this. And who will come to their rescue? Who will think about that? So we have to also think about their welfare or their solution of their problems. So this point I definitely like. I like the panel to discuss these 2 circulars which are very vague, not definite. What concrete or definite yardsticks or tests can be laid down for giving direction to the assessing officers? And I'd also like to tell that this seminar is not only one-time effort made by the Bombay Stock Exchange. We are concerned about the problems of the brokers, their clients, and this will be a continuous effort, and this will be a process on our part to help you and provide services wherever is possible, and we need your cooperation. Thank you very much.
Those were interesting thoughts, Jindal sir. Quickly, just to set, yeah, Agarwal sir, you had a question?
I think few problems are arising because of we are sticking to the old structure of the market. Probably earlier, I mean, just my personal thoughts. It just came to my mind as Mr. Jindal expressed his thoughts. Probably earlier the market was one, so everything used to happen in the same market. For example, investment was there in the same market, speculation was there in the same market, and business was also there in the same market. So product was same, and you were having different nature of the activity. Probably now the market has become much more segmented. So there is a need for probably defining certain products as investment products or certain products as speculative or business. So probably I would think, I mean, my wishful thinking as a securities market regulator, that if somehow the cash market can be spared of the complications, because this is a market which should be considered mostly investment market, because other products are available. Most of these speculators, for example, are there in the F&O. So this market, if this market can be spared of the tax complications, so that real investment activity is promoted and the small savers are able to participate in the cash market with little difficulty. So I think there is some need to give thought over this. We will have a sense of proportion. I mean, if the problem is not that big, why to unnecessarily cover the whole market? Even if some tax is lost because of certain trading activity or business activity in the cash market, well, let it be. I mean, that kind of policy decision probably will have to take at some point of time. If we really decide that this is the useful market and this is very crucial for the mobilization of the savings. Thank
you. I mean, that's a really interesting thought. You know, what you're saying, sir, is, I mean, if I interpret it you're suggesting a structural, a fresh approach. An approach to taxation which is linked more to looking at products, nature of products and nature of investments, rather than worrying about the behavioral or intention part. Today, because of the intent, it's very difficult to say whether it was speculation or whether it was income. You're getting into those complexities because you started with the structure, and as the market evolved, you didn't change the structure, basically. I suppose that's a very good suggestion. If you once again take a complete fresh look, a total fresh look, and link the taxation to products, but define products clearly, so that the products also themselves do not get sort of, merged with different colors, basically. If you just did that, then it becomes very simple, I suppose. It's a very fresh approach. It's a unique thought, I must say. It's a good takeaway from this seminar. And I suppose I'll request Jindal sir to really, I mean, if you're constituting a paper on this, then this is an important thought that has to come in. Right? Exactly. It's investment linked completely. I mean, basically a product linked within that investment market, basically. It's a very, very, very interesting approach, basically. In the same note, before I move on to Doshi Saab, and Doshi Saab is one of the most senior, most respected professionals in the industry today. Before I move on to that, may I place a small request with the participants? If they have questions, put them on small pieces of chits or papers. People will go around, collect your questions. What we will try and do is, after the per se inter-panel member discussion is over, then we'll try and address those questions. If some of the questions do not get answered, then I suppose we will make an effort really to get back and give you some kind of a response to that. The panel members will make an effort to give you a response. That would make this seminar far more rewarding and far more useful, I thought. So not only do we create a paper, but we also make sure that the participants' queries and questions are answered. That's something that I thought we could really do as a panel. Sir, your thoughts?
Friends on this side, friends on this side. The last speaker in cricket parlance is referred to as the tail ender. Tail ender is entitled to hit only sixes. So I have also, sir, to make your task very simple, including the task of the people who will be drafting the memo for the finance minister, is I sat down ever since I received the invite, along with the circular of 2007, and I was sweet enough to also attach the CBDT circular. And then instead of consulting or sitting down or disturbing stalwarts like Ashwin Rai or Ketan Dalal, both associated with Big Four, I sat down with an investor, a real hardcore investor. And I told him, boss, what is it that is bothering you? And what I'm going to share with you, some of them are real sixers, are pain points of an investor and the solution that investor, a hardcore businessman and an investor found. So the first, he told me, Mr. Doshi, the circular you are referring of 2007 itself recognizes that I, as a person dealing in shares or putting money in shares, can be having two accounts, one on investment account, one on trading account. As if that is not enough, there is one Bombay High Court judgment in the case of Gopal Purohit, to which Ketan's presentation did make a reference, and a very interesting point he made was that income tax tribunal held in favor of Gopal Purohit. Bombay High Court upheld income tax tribunal's view and Supreme Court rejected income tax department's special leave petition against Bombay High Court judgment. Therefore, in my humble opinion, and the facts in Gopal Purohit's case are very interesting. Mr. Purohit, like a stockbroker, had maintained two accounts, one for investment, one for trading. And even the capital gain he made on the investment side, in one case was less than 30 days. And yet Bombay High Court and the tribunal, based on the facts, came to the conclusion that it is capital gain. Short term, because less than 12 months. Point I'm trying to say is this, that this investor, with a view to putting an end to all his miseries, said, Mr. Doshi, मैंने तो दो चार फाइल बना दी. मैं as individual, the husband, is the trader. So I admittedly file my return of income showing whatever little surplus I have as business income. But what I do is, with regard to the shares that I hold on long-term basis, I show it in my wife's income tax file. My wife is an investor. She makes short-term capital gain. She makes long-term capital gain. I make only business income. And usually, most of us know, if you are a trader, you end up with a loss. Don't ask me how. So then that loss has tremendous advantages. Apart from several other problems being solved, that loss is available for set-off. That loss can be used for being business entitled for all expenses. For all you know, it is the expenses which makes my income under the head business minus. So finally, he said, Mr. Doshi, are you not aware of the recent Vodafone judgment decision of whom? No less than Indian cabinet headed by the Prime Minister. And what did they hold? They say, we are going to accept the Bombay High Court decision, notwithstanding the tax effect. Not only that, all cases involving similar issue will be governed by the Bombay High Court judgment, which held in favor of Vodafone on those facts. Finally, my humble submission would be that if that is the spirit of the cabinet directed to the income tax civility, which promptly next day, 28th January 2015, issued a circular to all the income tax department officials that income tax department has accepted Vodafone Bombay High Court judgment and we are going to follow it. Point is, Vodafone decision and the civility view on that issue, why can it not be extended based on Gopal Purohit's case, upheld by Bombay High Court, rejected Supreme Court, SLP, accepted. Rakesh Mohan sir, with all the due respect to you, accept this and go out and send out a new signal. The India has changed, sir. As Agarwalji rightly said, times have changed. So when are we going to recognize these change times? Only after your retirement, the way Mr. Jindal is now a very wise man. When I was hearing Mr. Jindal making a confession, No, let me complete, sir. Greatest respect to you. There was no intention to hurt your sentiments. Point I am trying to say, let us accept the new regime, the new era which has dawned. And how will you do it? Respect the income taxpayer. Trust him. If he says this is my capital gain, accept it as capital gain. Why go into everything else? How many transactions is that and the other? Trust him. And all that for 15%. 15% is what I paid already for on my short-term capital gain. You want balance 15% by treating it as business income. Forget that. The amount of time you will save of countless officials of your department, countless taxpayers. Maybe Ketan Dalal will be hurt. But we all will live a very peaceful life. And believe me, sir, if you trust your taxpayers, taxpayers will trust you and the income tax department. Thank you very much.
The panel member discussions of your point, sir.
Just a minute. The case of the decision of Bombay High Court in the case of Gopal Purohit has come only in the year 2010. 2010 or 11, and 7. I was dealing with the appeals of, I was CIT Central Appeal in about 4 years, 94 to 98, and was dealing with the case of the scamsters who were involved in share scam case. They were very big and leading brokers. I would not like to name the brokers. So that broker in that particular appeal, he was having two accounts. One is stock in trade and the other investment account. The ITU did not allow the investment account. He said, no, your main business, you are the share broker dealing, and then he added everything. But even in 98, when this case was not there, but this logic was adopted by me, and I allowed the whatever profit or gain was made in the investment account, I allowed him as long-term capital gain or short-term whatever treatment was to be given. So not that while in service I tried to be very reasonable, broad-minded, and neither I was favorable to the assessing nor to the department. I always said them, I want to be impartial. If it is due to you, you can take it. If it is not due to you, I am not going to show you any leniency just to get credit. So that had been my working all the time, and I worked for 4-5 years in the scam cases and did to the best of my knowledge whatever I do. Thank you.
Sir, on the issue of having faith on the taxpayers, I would like to bring on record that the Income Tax Department does a scrutiny of only 3% of the returns filed in the country. That faith exists, yes, 97% we accept. But that faith is coming and the times are changing, and I'm sure with time your issues will get sorted.
Sir, general observation or other perception amongst broking community and investment community. As he correctly mentioned, when you go to assessing officer for assessment, quite likely, certain points which are raised and discussed, assessing officer says, I'm quite convinced about what you are saying, but I have instructions and I'm going to treat you in this manner. But I'm sure about it that this will be allowed in appeal. So you are forced to go into for that. Appellate body sometimes says, okay, I'm also convinced on this point, but I am not going to allow this. But quite likely tribunal will allow. So the SSC is asked to go from such points from assessing officer to appellate to tribunal body. This is one observation. So second, in a very frank manner, so what you mentioned in your speech, saying that cautious stockbroker, beware about it. Sir, stockbrokers, I think there are only 2,000, 2,500 odd stockbrokers in the country, I would say, who are active. And sir, what we are seeing is we are your agents. We are your agents in collecting secure transaction tax. We are your agents in collecting stamp duty. We are your agents in collecting service tax. But somehow, the feeling is what we get is, we are not taken as your partner. We are not taken as your friend. But we are taken always as as a suspect. So this is something which should be really to treat us as if, we are your partners.
Now, responding to your second aspect, the scenario is changing. We are a quasi-judicial authority. We do investigation and we are also decision-making authorities. So when we are doing the investigation part, inherently we tend to treat you as a defaulter. If you don't do that, we will not be able to do the investigation. Once we shift from there to the decision-making, we should cut off our process from there, which we are not able to do. It's a fact we are not able to do. But things are changing. Slowly things are changing. And on the first aspect, there are two issues which immediately come to my mind. First is that I talked about the reference to additional commission. That is a very effective method because you escape the entire route of tribunal and all. If you can get justice from additional commission, why not? So in the course of assessment proceedings, while it is going on, you can approach the additional commission for the actions. It's provided there in the act. Second is, we have also developed a cut-off system of appeals, at least for the tribunals. We have limits. Up to this limit, we will not approach them. So if the tax effect is less than that, we don't go appeal to tribunal. We are on that process.